Every year, the IRS audits less than 1% of individual tax returns. But for small business owners, sole proprietors, and high earners, that number is significantly higher. And it is not random. The IRS uses a scoring system called the Discriminant Information Function, DIF for short. Every return filed is automatically scored against it. The higher your score, the higher your probability of selection for audit. Most people who get audited never knew they were being scored. This video breaks down the 4 specific triggers that elevate your DIF score and flag your return for review, pulled directly from IRS documentation, tax court records, and published audit guidelines. This is not speculation. This is the mechanism. Before we get into the 4 triggers, understand what an audit actually is. An IRS audit is a review of your tax return to verify that the information you reported is accurate. There are 3 types. A correspondence audit, the most common, is conducted entirely by mail. The IRS requests documentation for a specific item on your return. You respond with records. It is resolved without anyone visiting your home or business. An office audit requires you to appear at an IRS office with documentation. These are more serious and typically involve multiple items under review. A field audit is the most intensive. An IRS agent visits your place of business or home directly. These are reserved for complex returns or cases where the IRS suspects significant underreporting. The 4 triggers we are covering today apply across all 3 audit types. They are the conditions most likely to get your return selected in the first place. Trigger 1, unusually high deductions relative to income. The IRS maintains statistical averages for deductions at every income level. If your deductions fall significantly outside the average for your income bracket, even if they are entirely legitimate, your return scores higher on the DIF system. This does not mean you should not claim legitimate deductions. It means documentation becomes critical the moment your deductions are above average for your bracket. The categories most scrutinized are charitable contributions, home office deductions, and business meal expenses. All 3 are legitimate. All 3 are consistently overclaimed. The IRS knows this and weights them accordingly in the scoring system. A home office deduction, for example, requires that the space be used regularly and exclusively for business. Not occasionally, not primarily, exclusively. A desk in a bedroom that doubles as a guest room does not qualify under the tax code definition, but it is claimed constantly. That pattern is exactly what the DIF system unreported income. The IRS receives copies of every 1099 W-2 and third-party payment report filed on your behalf. Every client who pays you more than $600 and files a 1099. Every bank that reports interest income. Every brokerage that reports dividends and capital gains. When your return is processed, the IRS automatically cross-references what you reported against what was reported about you by third parties. Any discrepancy, even a small one, flags your return for review. This is called the Automated Underreporter Program. It runs on every single return filed. It is not a human reviewing your documents. It is a system matching numbers, and it is accurate enough that unreported income is one of the leading causes of audit selection across all income levels. The most common version of this mistake is not deliberate fraud. It is a 1099 that arrived late, was misplaced, or was simply forgotten. The filer did not intentionally omit it, but the system does not distinguish between intentional and accidental. It flags the discrepancy regardless. Freelancers and independent contractors are disproportionately affected by this trigger because they receive income from multiple sources, each of which generates a separate 1099. Missing one in a stack of 15 is not unusual, but the IRS has all 15 on file before your return is even processed. The correction here is straightforward. Maintain a running record of every income source throughout the year. Do not rely on receiving the 1099 to remember the income existed. The obligation to report is yours regardless of whether the form arrives. Trigger 3. Cash-intensive businesses. The IRS applies additional scrutiny to business categories that historically underreport cash income. Restaurants, salons, car washes, contractors, and retail operations that handle significant cash volume are flagged at higher rates than businesses that operate primarily through traceable electronic transactions. This is not a judgment about the business owner. It is a statistical pattern the IRS has documented over decades of audit data. Cash transactions are harder to verify independently, which means the IRS verifies them more aggressively when a return is selected. For cash-intensive business owners, the audit risk is managed through meticulous record-keeping, daily cash logs reconciled against register totals, matched to bank deposits maintained for a minimum of 3 years. The documentation burden is higher, but it is the only defense available if the return is pulled. The specific red flag within this category is a cash-intensive business reporting consistent losses. A restaurant that has operated for 4 years and reported a loss in 3 of them will score significantly higher on the DIF system than one reporting modest profits. Consistent losses in a cash business suggest to the system that income large charitable contributions. Charitable deductions are one of the most scrutinized line items on individual returns. The IRS maintains average contribution data by income level. A return claiming charitable contributions that are disproportionately large relative to reported income will score higher on the DIF system, regardless of whether the contributions are legitimate. The documentation requirements for charitable deductions are specific and non-negotiable. Cash contributions under $250 require a bank record or written receipt from the organization. Cash contributions above $250 require a written acknowledgement from the organization, stating the amount and confirming no goods or services were provided in exchange. Non-cash contributions, donated property, clothing, vehicles, equipment, require additional documentation depending on the value. Contributions above $500 require Form 8283. Contributions above $5,000 require a qualified appraisal from a certified appraiser. The failure point for most audit cases involving charitable deductions is not the contribution itself. It is the documentation. The deduction was real. The paperwork was not maintained, and without the paperwork, the IRS disallows the deduction, regardless of intent. What happens when your return is selected? If your return is flagged for audit, you will receive a notice from the IRS, typically a CP 2000 for the Automated Underreporter Program or a Letter 2202 for a field audit request. You have the right to respond with documentation. You have the right to representation. A CPA, enrolled agent, or tax attorney can respond on your behalf. And you have the right to appeal any finding you disagree with through the IRS Office of Appeals. The audit process is not a verdict. It is a request for verification. Taxpayers with complete documentation who respond promptly and accurately resolve the majority of audits without additional tax liability. The ones who face significant assessments are typically those who claim deductions they could not document, reported income inconsistently, or failed to respond to the initial notice at all. The 4 triggers in this video are not secrets. They are published audit selection criteria that the IRS makes available in its own documentation. What most people lack is not access to the information. It is the habit of reading it. In the next video, we go deeper into business structures, specifically how operating agreements determine what happens to a company when a partner exits, dies, or becomes incapacitated. Most operating agreements are silent on all 3. This is verdict paper. Every collapse has a paper trail.